Are you an overwhelmed SaaS founder ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where masters are just beginners who never gave up. I'm your host, Jeff Maines. Well, here we are a week into 2023, and I hope you're off to a big start. For me, coming back from break or vacation, I'm either 110% ready to go and focused, or maybe sometimes a little bit slow to ramp back up. So which are you, or maybe somewhere in between? I found 7 keys to help start the new year off well with my team. Happy to send you the full list, but here are 2 in just a few sentences. First is the obvious one, is that we probably don't say it often enough, is to make sure that your team has clear goals and objectives so that they know exactly where they're going, how they'll be measured, and then reaffirm your backing. The key there is really accessibility and giving them the time and support that they need. And, backing that up with action, and then, letting them run, not micromanaging the process, but really turn those outcomes over to them. The second one I'll mention here is brainstorm sessions. These are fantastic. They promote creativity, solve problems, add innovation, and really get different perspectives. The really cool thing about all of that is it really unifies the team. I have a framework on how to run these sessions really effectively, but they're a lot of fun and really help team members speak up, especially the ones that maybe don't speak up quite as often. But they'll speak up, excel, and they up their game. And so you probably want to up your game also. So let's brainstorm. Join today's sponsor, Champion Leadership Group, at a virtual meetup for SaaS founders. It's called Navigating Success Together. Learn 4 key ways to keep growth going in uncertain economic times, including a master level strategy called the Yes Box. Most importantly, this will be a focused time to build relationships with fellow SaaS founders, up-level your leadership skills, and mastermind solutions with those on the same SaaS building journey as you. It's free for SaaS founders. Get all the details at navigatingsuccesstogether.com. or it's up at the top of the SaaS Fuel page under resources and events. Space is limited, so be sure and sign up today. We'll include a link in the show notes as well. In last week's episode, we talked with SaaS RevOps legend, Ray Reich, founder and CEO of RevOps Squared. Super insight into the KPIs and metrics all of us SaaS founders and execs should be measuring and manage. I know metrics can be one of those subjects that can be kind of dry and boring, and honestly, often it is. And that's one of the ways where I think Ray really stands out. He provides context, and when I understand the what and the why, that really helps. So if you missed it, go back and dig in. It was a fantastic way to start the year and things that we should be thinking about as we're moving forward, growing our businesses. So I really appreciate Ray being on the show and sharing the SaaS Benchmark Report as well. If you don't know what that is, you have got to get your hands on that. SaaS Benchmark Report. Go back and look at the last episode. There's a link in the show notes, and you can thank me later. Actually, you can thank Ray. He's the one that did it. My guest this week is Thomas Smale, CEO of FE International. Thomas is a serial entrepreneur who is exited and now advises founders on exit strategy, growth, and business development. He started FE International with the aim of helping self-funded entrepreneurs who are running profitable businesses exit. And from that vision, Thomas has built FE into the industry-leading M&A advisor for $1 to $100 million technology businesses. So here to update us on the financial jungle that is SaaS M&A right now, Thomas Smale. Hey, Thomas, welcome to SaaS Fuel.
Hey, Jeff, thanks so much for inviting me on.
Definitely. Really excited about our conversation today. If you would, give the audience a little bit about your background and how you got to where you are, particularly with the M&A work that you're doing.
Sure. So I founded FE International in 2010. Our backstory was we started out buying and selling very small businesses for ourselves. So that was the beginning of the business. We're talking $100 business. We would then do a little bit of work and then sell it for $500. So that was kind of the bootstrap story very early on. The very first thing we did before anything else was we then wrote a book and a course about how to buy and sell websites. So the initial plan for the business is that we would be a company that helped people buy and sell businesses through teaching and courses. I guess the very short story is what happened is people who went through the course started approaching us and saying, hey, I've read the book, read the course, I've been in the forum, watched all the videos, all the materials. I actually just want someone who will sell my business for me. So at the time, I didn't really know what the technical term for that was. Turns out that it's M&A, or back then, I guess you call it like business brokering, where essentially we help people sell their businesses and they pay us to do that. So that's exactly what we did many years ago. I guess 12 years on, the business has really compounded from there. Like we've closed well over $1 billion in transactions with people in SaaS, e-commerce, and content-based businesses. But essentially anything online we help represent. We've worked with over 1,200 founders and companies in that time. But it's really compounded from day one to the stage where now all we do is M&A. We only help sell companies. We don't sell courses anymore. We don't write books or anything like that. All of the content we produce is essentially free at this stage.
That's great. And it's a very different model than what most people probably expect in the M&A world. I mean, typically you get calls or emails of, hey, interested in buying your company, or, we want to invest or give you a loan or something like that. We want to fund your company. So this is a very different model to what the typical VC model is.
Yeah, absolutely. It's not, I guess the two differences are a VC specifically, they're generally investing into part of your company. So, hey, we want to buy 10% of your company, right, 20% of your company, and you still have to run it. The purpose of M&A is you want to sell your company outright and you want to leave the business. So almost all of the clients you work with have built something successful, but they want out. They want a payday. They want to be able to go work on something new. So two completely different things. One is selling a company outright, and two is taking investment. So generally speaking, VCs are not buying companies outright. They're only ever buying partial stakes.
Right.
And
we're doing roll-ups into bigger organizations.
Yeah, exactly. They might still be doing that. So sometimes, for example, we might work with venture-funded companies who are making acquisitions, and they might say, hey, we want to buy a software platform that does X, which will complement our business that does Y. We have $250 million in venture funding. We're able to invest some of this in making acquisitions. So there's definitely some overlap in that world, but I guess traditional venture capital is investing in the founder more than anything sometimes, whereas what we're doing is helping the founder get out. So almost the complete opposite.
Like that. So what is it that makes a company valuable? Why is one company more valuable than another one?
So generally speaking, and this is probably a little bit of an unpopular opinion because people think it's like quality of product, idea, how smart the founder is, all of those kind of things. But ultimately it comes down to cash flow. The vast majority of buyers are buying businesses that are making money, which is probably prerequisite one for being able to sell your business. Growth rate is important. If you have two identical businesses, one is growing at 20% a year, one is growing at 50% a year, the one growing at 50% a year is worth more than the one growing at 20% a year. And likewise, you could have a fantastic product, which is amazing and everyone loves, that makes $100,000 a year, or you could have a slightly more average product that sells $10 million a year. Regardless of how good the product is, a $10 million a year business is always going to be worth more. There are definitely some exceptions to that. You'll also hear these unicorn stories or like rare stories of acquisitions that have happened based just off IP or just off the founder, just off one meeting. But the reality is that's not really how 99% of deals happen. They usually are based on cash flow. An acquirer is looking to buy that business because it adds to what they already have. Or if they don't have a business, they're buying it because they're replacing a job as income or something else.
Right. And that makes a lot of sense. And it is those outlier stories that we hear a lot. somebody, a company has huge growth and is losing millions of dollars a year, and they get, acquired, or there's some massive deal that happens. Is that really reality, or is that really the outlier?
I'd say deals that get announced in that kind of way are more the outlier, because one of our big challenges from a marketing perspective is a lot of the deals we work on, regardless of the size, never get announced. No one ever hears about them. Like, we know they happen. The buyer knows they've happened. The seller does. Maybe the team do, but they don't necessarily get announced. And there's various reasons why you might not announce a deal. But generally speaking, a lot of acquirers, some of them want to build up a portfolio quietly. They don't want kind of unwanted press, because there could be many challenges to that. It can be disruptive to the team, and it can be disruptive to clients. Like the business, maybe you've bootstrapped your business to $10 million in revenue, and then you've sold it for $50 million. And then suddenly it gets announced that it was bought by a business worth $1 billion. And then customers hear about that. And this is the kind of questions that come up, whether or not this would happen in reality. I guess it's hard to know, but customers hear and they start negotiating harder, because they're like, well, this is not a small family owned business. It's now owned by a big private equity firm. Or maybe the team are like, well, we want to get paid more money because we're now owned by a big business. So there are lots of reasons why deals don't get announced. Some do as well. But I'd say the vast majority of transactions kind of happen quietly. You would never hear about them. It's not like in the world of, say, real estate, where there's a public kind of log of kind of properties that have sold in the US, for example. There isn't really a central repository for businesses that have sold. There are certain places you can get some of the information, but it's not 100% perfect or 100% reliable. Yeah, so often the big deals, or for whatever reason, if it was a popular deal, like a well-known founder or something, those deals you hear about. But I think many people would unknowingly come across people who have sold a business and they would have no idea.
That happens a lot. And you're correct. There are a lot of reasons for that.
Yeah, and I think also a lot of people, just when it comes down to it, a lot of people, if they have quietly built a very successful business, lots of people like shouting loud about how successful their business is, but like what success means, the scale in my mind is vast. To some people, successful is $50,000 a year in like personal income. To other people, you're not successful unless you're making 50 million a year in personal income. So success is very hard. And I also don't think there's any correlation with how loud people shout about their success versus how successful they actually are. In my experience, the vast majority of founders who cash out, say, 5 million to 100 million, so by almost any measure of successful, almost none of them talk about it. They might say, they'll be very humble. They might say, I was fortunate to exit a business. But very few of them go around saying, oh, I made $50 million. And if they do that, they probably have some sort of agenda, which is selling a course or coaching or a book or something like that. With my more cynical hat on of someone who sees a lot of this stuff behind the scenes.
or maybe it was 50 million and then they paid off 48 million in debt.
Well, that's another thing as well. A lot of people hear
they're investors. Yeah.
Why you should always be skeptical of deals that get announced when they announce price. Never actually know how much of that got back to the founder or founders. There's many, many examples of companies that have sold for $1 billion where the founders have walked away with nothing or close to nothing. And then we have multiple examples of people who sold a business for $10 million and they walked away with $10 million because they owned their business outright, had no debt, no investors, no other shareholders. Yeah, so headline number doesn't necessarily tell you the whole story.
Sure. Many listeners are bootstrapped, and I love bootstrap founders and holding on to their equity. If they're doing that, what are the key metrics, or really even venture funded companies as well? What are the key metrics that they should be paying attention to in growing their business to increase their valuation?
So I think every business is unique. So firstly, there's not a generic answer which applies to everybody. But I would say almost everybody should be tracking revenue and revenue growth. Both of those things are important. Assuming you want to sell your business for the maximum amount possible, growth is important. Although there are very many arguments, you can have a business that isn't really growing, makes 5 million a year for the next 50 years. That's in most cases still a fantastic business if it's profitable. So yes, growth rate is important, but maybe you don't necessarily want a business that's growing because you don't want the hassle of managing more people, managing more clients. You want to keep it small. So it won't necessarily apply to everyone. Margins, whether that's gross or net margins. I think in any small self-funded business, like your average listener, it is important to be profitable because you don't have investors kind of propping up the balance sheet or allowing you and your team or whoever to get paid if there's kind of no positive cash flow coming through.
Right.
I'd say in almost every SaaS business, you should be tracking revenue turn or net revenue retention, net dollar retention. There are tons of different, very similar ways of describing the same thing, but essentially how well are you retaining your existing customers and how is their revenue expanding over time, if at all. I'd say almost all acquirers are looking at that as a metric. Some businesses also make sense to look at customer churn. I haven't seen many examples where customer churn makes more sense than revenue churn. But again, everyone listening to this will have a unique business, so there may well be some nuances in there. I'd say in a SaaS business, they're the main ones you should be thinking about. There are tons of other metrics that probably do matter. So things like LTV, ARPU, CAC, so cost of acquisition.
Right.
But that really varies because a lot of the time, if you ask a VC, they'll say CAC, how much does it cost you to acquire a customer, is really important. But in a lot of bootstrap businesses, they don't spend anything on marketing. So it's like, what did you spend? 0. How much did you acquire? 10,000. How does that work as a ratio or calculation? It doesn't. Right. Whereas a lot of the time in VC funded companies, they're saying, okay, we spent $10 million on paid ads and we generated 30 million in LTV. So our CAC to LTV ratio is 1 to 3. That's okay. We can keep throwing money at this. So that's why you shouldn't, I guess, hear a list of metrics you should definitely track that a VC have told you about. Because if you're a self-funded business, it doesn't necessarily make sense to track those things. And then depending on your goals and your values or whatever you're trying to optimize for, there may be many other things you track as well. But I don't think any business should care about, at a CEO level, more than 5 metrics. You should probably track. So at IFE International, for example, we probably track 1,000 different metrics. If you look within every single team, what every person is measuring. But what I care about is not necessarily each of those 1,000 metrics. But chances are, I don't know, for example, one of the metrics we track is number of SQL, so qualified leads we get per week. But the reality is that number I care about, and I care about that number increasing. But if someone's job is a particular part of generating those leads, there's probably 20 or 30 metrics they have to track to make sure leads are getting generated. So at a high level, as a business owner, you should probably only really care about 5 metrics. You might just care about one, which is revenue and I guess profitability. Those 2 things might be the only things to care about. And then have individual people within your team responsible for the, I guess you call it sub-metrics or metrics that go into each department. But that obviously really depends on the size of your business. We have, across everything we do, have about 150 people. And I always like to have people responsible for at least a couple of metrics. If you have 150 people, 5 metrics each, that's 750 metrics that we're measuring organization wide. If you have a team of 5, it's going to be different. You shouldn't be measuring kind of 150 metrics each to get to 750. You should be measuring 5. And then you can get more detailed over time. So that's always the way I've approached it. If you asked me this question 10 years ago, I would have said, oh, here's a sheet of 20 metrics you have to be tracking.
Right, we see those a lot.
I think a lot of people still do that. I think if you're going to sign up for coaching and they're like, here's how to grow your business, they were like, here's the SaaS metric cheat sheet. 20 things you must know. But in my experience, if you track too much, it gets quite hard to focus on what you really care about. Because you could be like, website traffic is really important because the more traffic I have, the more SQLs I get. So in some businesses, that's not actually really true at all. I know for us, years ago, I used to care about traffic. And I was like, traffic's really important, has to be increasing. And then when we actually look at what kind of traffic we were getting, a lot of it was, say, pointless traffic, but it was not traffic that was converting to leads. So then if your traffic declined, but your leads increase, does it really matter? No, if you focus on just SQLs. So it's very nuanced. It really depends on the business, but I definitely wouldn't encourage people to think about more than 5 per person.
I think that's a really good answer. And there are lots and lots of lists out there of here's all the metrics that you should be tracking. And some of them matter, some of them don't, like you said. And then there are other metrics where we've tracked in the past that we don't track anymore because it was really important. And now there's another one that is more important. Or it's, the business has changed, or there's, the North Star really hasn't changed. And so we keep that. But some of the other sub metrics do change based on the goals and where we're going.
Well, I think that's a really good point as well. And something to think about is like the North Star metric probably never changes in any business unless you pivot your business model. But the most important metrics to you will and should change over time. And if you're never changing them, then I would argue maybe you're not looking critically enough at your business and like what matters. Because years ago for us, for example, traffic would have been one of the top 5 things I cared about to our website. Because I was like, well, traffic is correlated to how well we're known, general like brand awareness. At this stage, we're a much more mature, older business with a good reputation. So I care way less about people randomly landing on a website. But changing is good.
That's good. That's a great answer. So what do owners need to be thinking about as they're looking at selling their business? What kind of, mental preparation, business preparation? What are the types of things they should be thinking about, and how early should they be thinking about those?
Yeah. So in terms of how early, again, you asked me this 10 years ago, I would have said day one, always plan for exit. My answer has now changed to once you have some traction and you've reached MVP stage. So the business is making money. It's a business you're going to work on full time or maybe as a side project or whatever, but that's what you're focused on as your main business. That's when you should start thinking about it. In terms of how you think about it, 2 things to think about. One is, do you have a time-based goal on when you want to sell? So I guess if you think about that in terms of like career, a lot of people are like, my time-based goal is retiring at 60 or 65. In a business, you might have something similar. It might be, I want to sell within 5 years. I want to sell by the time I'm 50. I want to sell by the time I'm 25. There is, I'd say, no right or wrong answer to that question. That's a very personal thing. So again, I could give you a list of 20 things to think about, but I can't make personal decisions for you like that. And then most people as well should have a value-based goal. And those could be a combination of 2 things. Like I want to sell for as much as possible within the next 5 years, or I want to sell within 5 years of when we hit $20 million valuation, whichever comes sooner. But have a value-based goal. And again, that really varies. Everyone has their own definition of success. There is not a right or wrong answer. You'll meet people who sold their business for $1 billion and will tell you they regretted it because they could have sold for $5 billion 2 years later. And you'll meet people who sold their business for $1 million and they'll say that's the best thing they ever did. And they were annoyed they didn't do it years earlier. So there's no right or wrong answer to how much selling for is like important to you personally. And then once you know what you're trying to achieve, and this is my mini sales pitch for FE International, get a valuation and establish what your business is worth. Any established M&A firm that operates in your space, we do a lot of SaaS businesses, we will value a SaaS business for free and tell you what you're worth. That then helps you plan what your exit looks like, because if you know today your business is worth $1 million and the number you came up with independently was $10 million, then you probably have quite a lot of work to do. So the answer to like, when should you sell is probably actually you need to go do some more work and come back when your business is, it's not an exact formula, but when it's 10 times bigger, then you can sell it for 10 million, not 1 million. But I think it's important to start with, you can start with a valuation as well, but start with an expectation of what you're trying to achieve, and that will help dictate the plan. Because I would say as well, like, you want 10 million, we say 1, you've got probably a reasonably long journey ahead of you. If you say you want 20 million is your magic number, and currently we say your business is worth 17 million, then probably you're actually very close. What do you really need to do differently? The answer is probably nothing. It's probably just run your business for another 3 or 6 months and you're going to get to that level anyway. But again, that's and the thing about your goal is that can change over time. I know for me, when I started out 12 years ago, I thought the pinnacle of success in business, because I didn't come from a family of business people or know any entrepreneurs, grew up in the UK, which is not a very entrepreneurial culture. Running a business is like discouraged, socially discouraged. You should go get a good job, get like a good degree, go earn a living, and do that for 40 years and don't complain. Hence why I now live in the US, because it's a very different culture of build a business. That's good. I would have said if we could get to $1 million a year in revenue, that would be life-changing. Definitely was life-changing. I think that first $1 million, but we're now well into the 8-figure range and profitable, and goals keep changing every year. I think what I previously thought was the limit of what we could do, we push beyond that, and then it just keeps going. And now I'd say my goal is completely different to where we started out. Some businesses, it could be the opposite. Sometimes you might even have to reduce your expectations. Some people might come in and say, I was trying to build a $100 million business, but maybe 10 million is as big as it can get. So your goals can go up or down. They don't necessarily just have to go up, but don't be afraid to change your goal and don't be too stubborn around it. I think that's important. I think a lot of people are like, oh, well, I wrote down 10 years ago, my target was this. If you're way past that at this stage, why not keep going? Which is why it's really a personal decision as well, because a lot of it comes down to, do you have the time, the personal energy? I think like running a business is not easy. A lot of people sell when they're just stressed and they're just like, actually, I can't do this anymore. The best way out is to sell, which is true. A lot of people, before I started, part of the reason I started FE International was there were not very many good exit options for people 12 years ago. So if you had a successful, well, SaaS wasn't really a thing 12 years ago. It was beginning to become a thing. It's more likely a desktop software product.
Right.
If you wanted out with your business, there weren't really many options to sell it. There was some examples, but most people were shutting it down or selling it to a business partner, giving it to employees, or just spending less time on it until it eventually died. So you definitely have more options today, and it's not just because we exist. There are other options as well, which is why I say your goal should change, because if you started a software business, say 15 years ago, what options you had back then were completely different from today. And I'm a firm believer there's no better time to start a business than today, particularly in the software space. Yes, it's a lot more competitive than it was 10 years ago, but there's also so much more. Podcasts like yours, for example, years ago, you probably could have found, I don't know, a couple of useful podcasts if you want to start a software business. Now, and I say this fully respectfully, there are 1,000 good podcasts you can listen to. Obviously, yours is the best one that everyone should be subscribed to, but there are 999 others that are going to give you fantastic advice as well, usually for free. And that didn't exist years ago. There's so much free information. There are so many SaaS products and other products that can help you build a business for free. Years ago, I think a lot of people didn't realize that you'd have to if you wanted hosting, you had to literally physically buy a server. Right.
Data centers and
and you had to manage it, because you would have to be like, oh, how much RAM do I want on my server? Whereas now you can just go to again, 1,000 hosting companies buy cloud hosting, and it's done in 5 minutes. So yes, it's more competitive. The market is vastly bigger. There's so much good information out there. So things change. If you asked me that question 12 years ago when I founded a business, those opportunities did not exist. It wasn't that easy to launch a business.
Right.
Most of the people figuring it out were I'd say most people successful back then were pivoting because they didn't know what they were trying to do. They were like, oh, maybe I can build a software version of my desktop software or of this course or whatever. Whereas now, I think a lot of people don't necessarily need to pivot because it's much easier to figure out what's going to be successful or what's not going to be successful quickly.
Right. We're going to take a quick break. And when we come back, we're going to ask Thomas about how to sell without regret and the key things we need to be paying attention to as we grow and approach sale after this.
Today's episode is sponsored by Small Fish, Big Pond, building a world-class business that swims circles around competitors. Why do some companies achieve explosive growth while others sink into the depths? What do exceptional SaaS companies do that mediocre companies don't? What can SaaS leaders learn from fish? Small Fish, Big Pond delivers powerful business lessons guaranteed to change the way you view your business and includes hands-on exercises and growth tools to get lightning-fast results. Get your copy today at smallfishbigpond.com and use the code SaaS Fuel to unlock special bonus content.
Welcome back to SaaS Fuel. My guest today is Thomas Smale, CEO of FE International. And Thomas, there are a lot of business owners that seem to sell their business and then regret that decision down the road. What are some things we should be thinking about or do in preparation for a sale so we don't end up in that position?
Yeah, so I mean, it's a really good question, and it's a very good point. It definitely does happen. So I think we've started getting into this, but I think if you go into it with a actual plan, and like I said, you either think about what's your time-based goal or your value-based goal, and you actually make a goal and you work towards that. That doesn't necessarily completely remove a situation where you sell and then regret it. But I think a lot of people, when they do regret, they sell because they're approached by an acquirer. And a lot of those deals also fall through. But sometimes there are situations where you get approached directly, that deal happens. People regret it because, and again, this is not supposed to be a sales pitch, but maybe they realize that they sold for $10 million, but the business was actually worth 20. So people regret because they've sold under market. And buyers who approach privately, in my experience, are very good at persuading a seller that their offer is the best offer in the world. There's no way anyone else will offer them a better deal. The reality is, in 99% of cases, running a competitive process will get you more than the cold offer that someone emails you from a random approach. So people regret by leaving money on the table and not running a proper process. So run an actual M&A process. This is what we say to clients is, you'll never walk away from, assuming that you work with a good M&A firm, you'll never walk away from the process believing that you sold for less than the business was worth. Does that change the fact that you sell your business for $20 million, you regret it because maybe you should have held on to it and built it to a $100 million business and then sold it? No. But do you walk away with the possibility of regret thinking, oh, maybe if I spoke to 10 more buyers, someone would have paid more? You don't. So that definitely helps.
Makes sense.
So I'd say, generally speaking, you're more likely to regret it if you don't plan, or if you also don't have a plan for what you're going to do next. Most people that come to us, if they have a time-based goal, it might be like, hey, I want to sell because I then want to go travel the world. I want to spend more time with my kids, or I want to have kids, or I want to go back to college and study something, or I want to be able to do whatever. I feel like if you move from one fulfillment to the next, people are way less likely to regret it. I think some of it's also personality type. I think some people are just prone to regretting things in general, and then other people aren't. So it really varies. But I say generally, the more you plan, the less you're going to regret it. The earlier you think about it, the better. Because I guess the more control you have over your exit process, the more choices you're personally making. So there's way less likelihood you'll ever regret it. If you're kind of forced to sell, or you sell without really thinking about it properly, you sell without getting a range of valuations or without speaking to enough buyers, then it's way more likely you're going to regret it. And that's why you should also not be afraid to change your goals with time. Because you might think, hey, for example, if I sold FE International tomorrow, even if we didn't get a very good deal, it would still be vastly, vastly, vastly higher than what I ever thought was possible 12 years ago. So
Sure.
Would I regret it? 100% yes. Would 22-year-old me starting a business regret it if you gave me the check or whatever it was back then? Like, probably
Right.
not. So that's why things should change as well, because otherwise you might end up regretting it because you've aimed too low. Or the complete opposite. Sometimes people aim too high and then they're too stubborn to change their goal when the business like stops growing or starts declining. And there are lots of reasons why that might happen. So you do have to be practical in both directions. Not every business will grow forever. If it was that simple, no one would ever. If you knew with 100% certainty your business will grow into perpetuity, very few people will ever sell. But that's not necessarily always the case.
No, that makes a lot of sense. And sometimes there's some taking money off the table. So what do you think about that, or how is that viewed from an investment or private equity standpoint, and doing an owner secondary where you're selling some of your shares, taking some money off the table, and continuing to grow the business?
Yeah, so my first caveat is FE International does not offer that as a service. So we only sell businesses outright.
Right.
But we do have some founders who will come to us and they might have already done that, or they'll come to us for a formal valuation. So it's usually called a 409A valuation, but there's lots of different technical things you can call it to arrive at what a business is worth. They'll do that because they have someone who's approached them to buy. It might be a VC. Sometimes VCs will offer to buy out part of your shares. Sometimes we have situations where a secondary might be a little bit different. So it might be you sell the business. There's two business partners. You sell the business outright. One partner wants completely out. One partner wants equity in the acquirer. So it might be they retain 20% equity in the new business. The partner's completely bought out. So I guess that's a form of secondary as well. From an exit process, doesn't really make any difference to us whether or not you've taken secondary or not, as long as you have the ability to actually still make decisions on behalf of the business. So if you've taken a secondary, but whoever's bought part of your share now has control, then they're the ones who want to be dealing with. But it can be a good way to, secondaries in general can be a good way to create liquidity in the short term. So you can buy a house or whatever you want to do and continue to work on your business to get to that higher valuation goal that we were speaking about a minute ago. So yeah, maybe you can build your business to $100 million, but if you never see any of that for 20 years, then I do feel like it's more likely you start to have regrets, because you're like, well, if I took a little bit out, I could have bought a house. I could have maybe taken not necessarily a vacation, but there's lots of things you might have been able to do if you took a little bit of cash out along the way. I would say we see secondaries are pretty uncommon with bootstrapped founders, because as your business grows, you're making more money. If you're profitable, you don't need a secondary because you can just take a distribution.
Correct.
So I think secondaries are more common if you're taking external funding, because investors want you to be fully invested in growing the business. And they often know that if you have $5 million in the bank and you can buy yourself a nice house and create a bit of financial stability for yourself or your family, then you're going to be more committed in the short, medium, and long term. So like I said, not necessarily something we specialize in or really know that much about, but definitely see it happen, and I guess pros and cons.
That makes sense. What makes a good transition in a sale? How do you transition from one company to another? How do you transition that ownership in a way that's positive for the business, the clients, and the employees?
Yeah. So firstly, the most important thing is finding a buyer who is a good cultural or value-based match for you. And that's also why it's important to not just sell to the first company that approaches you, why you should run a comprehensive M&A process. And what we often find, or almost all the time, most people have a misconception that a business always sell to the highest bidder or the highest offer. That's not necessarily the case, but sellers will often sell to a buyer they like the most or they think is the best fit for taking over and running the business and meets their goals. So to the second part of your question is that really depends on what you want as a founder. Some people come to us and they're like, hey, Thomas, I want to sell my business. I'll do a week of training and handover. Then I want out or don't want to do anything.
Right.
And other people will say, I want to sell my business, but I'm quite happy to stay on as CEO. Like, what do you think? So I guess we can do either, but it really depends. Without trying to be facetious, there's no good transition because a good transition depends on what you want. If you want out on day one, but you're actually stuck supporting the business for 2 years afterwards, probably not a good transition. If you want to stay with the business for 2 years and you're out on day one, that's also not a good transition. So you should, as well as thinking about your time, and that's why I spoke about time-based goals for your exit at the start as well. Like that timeline can include post-exit as well. And buyers really vary in terms of what they want. We don't have every single buyer wants you to leave on day one. Every single buyer wants you to stay until the end of year 2. There's a vast range of buyers and what they're looking for. So that's often why sellers choose to go with not necessarily the highest bid, or if there's 3 bids all at the same level, they'll go with the one they like the most. It's because transition is important for them and their team. And with these things, like I think many things in life, there's no guarantees as such. But if you're very clear about what you want up front, particularly with us, if we're representing you, if we know what you're trying to achieve, it's much easier for us to find a buyer that does that. But I was working on a deal just before I jumped on the phone today where a client we've run quite a comprehensive process. And I think he has 7 offers to choose from. And the offer he's gone for is the 3rd highest. But he likes this. They're not drastically different. So it's not like $10 million difference between the offers. But he's taken that offer because he believes the buyers will be the easiest to work with and will do a best job with the business and kind of likes what they're going to do into the future and their overall vision. So that's why running a comprehensive process is important, is that you then have optionality and you can choose what's best for you and the business and your employees and whoever other stakeholders that might be involved.
Yeah, that alignment is so important.
Yeah.
So do you think most buyers are buying the same thing that sellers are selling, or do they have different ideas for the other one?
That's a really good question. I would say it very much varies. Some people, or some acquirers, are literally just buying what a seller has and they're planning on running it exactly the same. Some are doing the opposite, which is they're buying it and they're going to completely change it. The reality is the majority of buyers are somewhere in the middle. They're probably buying what already exists because they believe they have a way to improve it, either by businesses they already own or some skill or strategy they have that will help them be able to do that. But they won't necessarily make those changes on day one. So they don't take over and then the next day pricing has changed, team have changed, website has changed, product has changed. These things are generally accretive and they'll happen over time. But in almost all cases, people are buying a business or companies are buying a business to improve it. As to what they're improving, there's, again, similar to the question about SaaS metrics, there's thousands of different ways people will identify to improve a business. There's no kind of right or wrong way to approach it. I'd say the majority of buyers who are successful in the long run have ways to increase the size of a business. So revenue-wise, profitability-wise, they're the ones who are going to be most successful in the long run. But one thing I've seen over the years is there's many different ways to successfully buy businesses. There's not necessarily a kind of playbook for the perfect way to do it. It really depends. But I'd say almost everyone successful at least has a way to improve a business.
That makes a lot of sense. How often do you see that buyers are telling a story about what they think that the seller wants to hear versus their real plan for the business.
Definitely happens sometimes. One thing I would say is if you're a bootstrap founder and you've bootstrapped your business to any sort of particular size, you probably have many good traits and you're probably at that stage quite good at judging character. So I'd say buyers are quite good at bullshit, but buyers who end up winning deals are generally not the ones who are lying. Those buyers tend to be, they're not going to be deals that we see very often because M&A firms like us will weed them out. If we think people are being shady or dishonest, we kick them out of the process. But if they approach you directly, you're not necessarily going to know what they're saying is true. So a lot of them will be like very misleading in their approach. I would say, again, the majority of buyers are good. Or the majority of buyers that we would bring to the table would be good and have good intentions. That doesn't necessarily mean what they say up front is exactly what's going to happen post-sale because they don't know until they own the business. They might come in. Equally, sellers will often, not necessarily intentionally, but they will hide things or things will be a little bit different when a buyer comes into what they expected. So their plan will have to change. Sometimes there are just externalities, as everyone listening will know, that affect your business that you haven't really been able to do anything about or predict. So I think most good buyers come in with good intentions, will follow along with what they say. There are definitely some unscrupulous buyers out there. But I guess part of the reason you hire us is our job is to filter them out and make sure you're not speaking to them. And if you do speak to them, we very quickly identify we don't want to speak to them further and kick them out of the process. If you just try to sell yourself, there are many courses out there that teach people how to buy businesses privately. And those courses are not teaching people how to give the seller a good deal. They're teaching, they're teaching you how to get the best deal as a buyer. So there are many people out there, unfortunately, who will say whatever they need to say to get a deal done, who won't necessarily follow along, which is why you need a good M&A firm, a good attorney, good accountant to make sure you have at least someone on your side.
Representation is so important, and having great representation in the process, I think, is just super important.
Yeah, exactly.
Well, Thomas, great conversation. Where can we learn more about you and FE International online?
Yeah, thanks, Jeff. It's been a great conversation, some really good questions and interesting points for people to think about. If you want to find us, easiest way, feinternational.com website. We publish a bunch of content, depending on what you like. Some people like podcasts. You've come to the right place. We have lots of written content. We have links out to content we've written. We're active on social media. So if you have a favorite, if you like Twitter or you like LinkedIn, you can follow us there and get different information. Some people like to go to conferences. We're regularly at conferences, speaking at events, sponsoring events. So if you want to meet someone in the team in person, you can find a list of events we're going to. But so yeah, start with our website, navigate around. If you want a free evaluation, as I've mentioned, we offer anyone with a kind of qualifying business a free evaluation. And we'd be more than happy to speak to anyone that, if you say you listen to the podcast, then we'll make sure the team prioritize.
Very nice. We'll make sure and link all of that in the show notes. Thomas, really enjoyed our conversation today. Thanks for being on SaaS Fuel.
Yeah, thanks so much. Appreciate it.
Thanks again to Thomas for coming on the show and sharing your insights and resources. Super, super helpful today. Learn more about Thomas and FE International at feinternational.com. As always, all links, highlights, resources, and full show notes are available at saasfuel.com. So please subscribe or follow us at saasfuel.com while you're there. And everyone who subscribes this week gets a free pass to Navigating Success Together. Okay, it's free anyway, but you should still subscribe. And I do hope to see you at Navigating Success Together. I will be there on both days. Come brainstorm and mastermind with your fellow SaaS founders and leaders and find out how to keep your solution in the yes box while other vendors get cut and booted out. So we're looking for your success here. Join us next week for our conversation with Edwin Filtvet, CEO of Favorite. Favorite is a B2B SaaS platform that is disrupting the hospitality industry and creating the world's best guest and customer journey for food and drinks. from startup to scale up in a single year and is now across 5 countries. He has a great story, and this is a SaaS company to watch for sure. If you don't know them yet, you will soon. Be sure to check it out next week. And until then, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSFuel. We'll be sure to read these out on future episodes.